Welcome back to the New Zealand Property Insights. I'm Paul Roberts.
And I'm Debbie Roberts. We're the owners of Property Apprentice. And as always, we're here to help you navigate the New Zealand property market with real facts, not just headlines.
Today, we're opening to episode 21 with a focus on critical, structural, political, and affordability pressure points. We're starting with a look at how our retirees are currently being squeezed financially from a multiple of different directions on fixed incomes.
This is an important conversation because those pressures are translating into real-world hardships that directly impact retirement planning and family support structures. We'll also break down the political debate surrounding the future of interest deductibility rules, which weighs heavily on the minds of investors as the election approaches.
Plus, we're wrapping up with some great news for buyers, analysing Massey University's newly released report, which shows a substantial 12.6% improvement in housing affordability over the first quarter of this year.
This episode is designed to give you a clear strategic view of the current cycle, so let's get straight into the data. Segment number 1, the retiree squeeze, multi-directional cost pressures, fixed income realities, and intergenerational tension. So kicking off this first segment with the latest findings from a nationwide survey conducted by Lifetime Retirement Income, which surveyed more than 700 seniors across New Zealand, with the vast majority of respondents aged 65 and over. The data shows that New Zealand retirees are currently facing a broad, simultaneous strain affecting almost every essential area of daily life.
This research highlights a notable structural challenge. When your income is fixed and essential expenses rise across the board, finding areas to cut back becomes genuinely difficult task. So let's lay out the facts. The latest survey from Lifetime Retirement Income reveals a broad, simultaneous financial strain affecting New Zealand retirees across essential living costs and expenses, council rates, healthcare, and income inadequacy. Cost of living remains the dominant financial concern for seniors, cited by 77% of all survey respondents. 5 of the top 6 financial concerns for retirees are directly cost-related, specifically covering groceries, power, insurance, petrol, council rates, dental expenses, and the adequacy of New Zealand super and household heating costs.
Structural pressures translating into direct hardship, with 4 in 10 surveyed retirees already struggling to afford their local council rates on a fixed income. Nearly 40% of respondents state that New Zealand superannuation simply doesn't stretch far enough to cover their rising essential expenses. Healthcare access and income adequacy are rated as non-negotiable priorities, with 90% of retirees rating timely access to healthcare as important or essential. Keeping New Zealand superannuation fully aligned with rising costs is rated as important or essential by 83% of surveyed seniors.
Aged care affordability is a significant concern for retirees, with 64% rating the issue 4 or 5 out of 5 in terms of importance. Retirees express significant concern regarding financial well-being of younger generations, specifically focusing on the cost of living for young families, housing affordability, and job opportunities. Generational worry is impacting retirement planning, creating tension for retirees who feel a responsibility to support their families while trying to meet their own daily income needs. These figures are a profound reminder of the realities of fixed income retirement. Cost of living being a concern for 77% of seniors shows that inflation that we have experienced over the past few years has left a permanent mark. And seeing that 4 in 10 retirees are actively struggling to afford their council rates is a significant statistic. Rates are an unavoidable expense. And when they spike alongside groceries and petrol, it leaves retirees with very few options but to draw down on the retirement savings faster or make severe lifetime compromises.
It's a major wake-up call for anyone planning their retirement now. Relying solely on New Zealand superannuation is just not going to be enough. Superannuation was never designed to be a complete wealth solution. It was designed to act as a basic safety net. When almost 40% of retirees says it simply doesn't stretch far enough, it proves you must build independent cash flowing assets during your working life to supplement your future income. You definitely don't want to be renting in your retirement for sure.
Absolutely. And we look at those closely to that intergenerational tension. Retirees are worried about children, grandchildren, particularly around housing affordability and cost of living for young families. This emotional and cultural desire to help the family can create a difficult financial choice. If you're dipping into your retirement fund to help your kids secure a deposit, pay their bills, you might be directly compromising your own long-term financial security.
You just can't pour from an empty cup. If you want to be in a position to help the next generation, you've first got to secure your own cash flow and protect your own retirement, ensuring you've got the financial capacity to support your family without running out of money yourself.
You can't save yourself to wealth. You need to invest and maximize your financial potential, and property investment gives you the added benefit of leverage. That investing in the share market or managed funds just can't compete over the long term. And that is why we give full financial advice to our clients to make sure that you're buying what works for your financial position over that long term.
Without putting everything into one nest.
Yeah. So the next segment, the interest deductibility, tug-of-war, election scenarios, cash flow thresholds, and the rental price debate. So for our second segment, we're addressing the ultimate elephant in the room with New Zealand's election just over 4 months away and the future of interest deductibility rules, or as what is often returned to on the political left as tax breaks for landlords, which it is not.
This is a policy debate that's generating anxiety among many property investors. We're analysing the direct financial mechanics of full deductibility, looking at the proposed political scenarios on the table and examining how a potential policy reversal, if we got a change of government, would impact on property values, housing supply and weekly rents. So let's have a look at the facts. First, let's start by stating the obvious. We're not accountants, and we always recommend that you seek advice from accountants who understand property investment. But in basic terms, interest deductibility allows property investors to claim the mortgage interest they pay to the bank as an expense before calculating their tax liability. Under full deductibility, a landlord receiving $40,000 in rent a year who pays $20,000 in mortgage interest is taxed only on the remaining $20,000 of profit, less any other tax-deductible expenses, whereas removing deductibility results in the landlord being taxed as if their property was already mortgage-free.
And that is just not the case. Most investors in New Zealand are mum and dad investors that own one rental property. So the previous Labor government began phasing out interest deductibility in late 2021 for existing residential rentals, while exempting new builds to encourage construction, affecting an estimated 250,000 property owners. Following the 2023 election, the National-led government reversed that course and fully restored the interest deductibility for property investors. Treasury and Inland Revenue estimated that restoring the interest deductibility would reduce government tax revenue by around $2.9 billion over the 5-year period, ending in 2028.
Labor leader Chris Hipkins is keeping the party's position open, stating that final decisions on interest deductibility will be released alongside the party's formal fiscal plan, which hopefully will get before election date. Economists suggest that reversing the rules again could lower existing property values slightly over time and create a pricing gap between existing homes and new builds by stimulating more residential construction activity. In other words, increasing demand for new builds could increase prices in that sector of the market, with values stagnating for existing properties due to reduced demand.
The Property Investors Federation also warns that if a significant number of landlords choose to sell their portfolios in response to a tax change, it would depress property prices, directly affecting owner-occupiers as well. And I think this is a really interesting thing because people only want prices to go down when they don't own any property. And as soon as they do, what do they want? They want prices to go up. So due to the increase of supply in existing properties for sale, when more buyers would have been driven towards new builds, Tax rates for landlords vary based on overall income brackets, with a 33% marginal tax rate being typical for many active investors. Just in case you were thinking that landlords don't pay tax, then we clearly do.
Industry advocates argue that losing interest deductibility would force landlords to raise weekly rents by $1.50 for every dollar lost in tax offsets to cover the typical 33% tax rate, impacting tenants or causing forced relocations. Obviously, landlords can't increase rents more than once a year, and they can't increase rents above market. But the implications are clear, that landlords would absolutely increase rents as much as they possibly could, and as often as they possibly could, in an attempt to offset their increased costs.
As we saw last time with the Labour-led government, interest deductibility was removed. Rents skyrocketed. This is what is going to play out in Australia now. And due to increased demands from tenants, when there were less rental properties available as landlords stopped buying and some of their older existing stock, there was a rent shortage and queues for people wanting to rent houses. Yeah. Economists note that while rent increases have slowed recently, this trend is driven by wider economic conditions, reduced tenant payment capacity, net migration outflows rather than tax restorations. In other words, we've got a balanced rental property market at the moment. At the end of the day, it boils down to supply and demand and nothing else.
Recent market data shows that home buyers face significant affordability pressures, with the average earner spending 40% of their income on mortgage repayments nationally and over 50% in some regions, even though it's currently the most affordable it's been for about a decade for both home buyers as well as tenants. What the left side of the political parties also seem to forget is that the economic contribution that property investors bring is significant. Based on the independent review by Infometrics, which is that spending by residential property investors on the maintenance and improvement of existing properties and on the building of new properties, in 2024 alone, their estimates were that residential property investors created $24.8 billion in GDP, generating economic activity across many New Zealand industries.
This amount equated to 5.9% of New Zealand's total GDP in 2024. Through this economic activity, residential property investors sustained 126,000 full-time jobs, or 5% of all full-time jobs in 2024. What we need to remember is no government can afford to own all the rental properties required to house people, especially as private landlords and trusts currently provide 85% of all rental properties available currently in this country for the third of our population that don't own their home
and need to have somewhere to live.
Deductibility debate goes straight to the heart of how different political parties seem to view residential real estate. One side treats housing purely as a fundamental right to shelter, using tax policy to restrict investors and level the playing field for first home buyers. The other side views rental property as a legitimate business, which it is, and should be taxed on actual profit rather than gross revenue.
Black and white views like this drive me nuts. While the left side of the political spectrum seem to state that they're there to defend tenants and first home buyer rights, their policies tend to have exactly the opposite effect. Under the previous government, we saw the strongest increase in house prices and also the strongest increase in market rents, certainly in my lifetime. The argument has always been that if a property investor sells, then it makes a house available for a first-time buyer to buy it. And that might be true. But where do the tenants go that aren't yet in the position to buy their own home? This is why rents increased so quickly the last time interest deductibility was removed, because supply reduced for rental properties and demand increased.
As investors, you cannot base your long-term strategies on an election year guesswork. You have to stress test your portfolio against the worst case scenario. If you're operating on razor-thin margins where tax change could push you to force you into a sale, you do not have a investment structure. Also, if a tax pushes property investors into the same sector that first home buyers are also pushed in, because of the lower deposit requirements, this is 100% market manipulation at its worst.
Exactly. And history proves time and time again that it repeats. What's the definition of stupidity? Doing the same thing over and over again, but expecting different results. So if Labor and their coalition partners truly believe that they can reintroduce the removal of interest deductibility without causing increases in market rents like we saw last time, what does that tell you?
But don't worry. The Greens have said that they will introduce a rent cap to stop landlords from increasing rents to help cover the costs of the change in the tax policy. And what will that do? Force more landlords to sell, making even less rental properties available for tenants who need them, pushing rents up absolutely faster than we saw the last time around, because they won't just go tomorrow, it'll be next year. And this reinforces the need to make your purchasing decisions based on the fundamentals of investing, cash flow. Because if you can afford to hold on to your rental properties in times of change, if we do get a change of government, then you will absolutely benefit over the long term. If you don't know the numbers, you're doing it all wrong.
Segment number 3, the affordability turnaround, easing median prices, rate reductions, and looming OCR risks. For our final segment today, let's talk about some good news for prospective home buyers that for some reason doesn't seem to be getting much attention by mainstream media. Good news there, it really does. But the latest home affordability report released by Massey University reveals a significant turnaround, showing that housing affordability improved by an impressive 12.6% nationwide in the first quarter of this year.
This is a welcome shift in momentum. The data shows that a combination of softer median house prices across multiple regions, a drop in mortgage interest rate, and rising household incomes work together to make buying a home more affordable and achievable in the first 3 months of this year. So let's look at the facts. According to the Massey University Home Affordability Report, housing affordability improved by 12.6% in the first quarter. This positive shift was driven by a drop in median house price across many regions, fall in interest rates, increase in household incomes over the first 3 months. Median residential prices fell in 8 of the 16 regions tracked by index, resulting in a national median drop of 1.6% over the quarter.
Marlborough also experienced the most significant quarterly lift in affordability, surging by 21.7%, while the West Coast recorded the smallest quarterly improvement, but still an improvement, at 5.5%. On an annual basis, national housing affordability improved by a substantial 23.1%, supported by a 1.37 percentage point drop in 2-year fixed mortgage rates and a 3.49% increase in average weekly earnings, despite annual house prices rising by 3% when you look at the national figures. Northland recorded the largest annual improvement in housing affordability, lifting by an outstanding 32%.
Annual affordability metrics across major centres showed strong progress, with Auckland improving 25%, Wellington by 24.3%, and Canterbury by 23.4%. Regionally, housing affordability remains the best on the South Island's west coast and the poorest in Auckland.
But still a lot better than it was.
Yeah.
Report author Ashad Javed, a senior lecturer in property at Massey University, highlights that most New Zealand regions have experienced double-digit year-on-year improvements in affordability since December 2024. And this sustained improvement is attributed to lower mortgage interest rates and a widespread reassessment of rateable values across most regions during 2024, which helped drive down inflated house prices. The report warns that the Reserve Bank of New Zealand may look to increase the official cash rate in its upcoming monetary policy announcement, which would likely push mortgage rates up and reduce housing affordability in future quarters.
So this analysis is incredibly positive news for anyone who's been trying to get on the property ladder. A 12.6% quarterly lift in affordability, a substantial 23.1% improvement over the last year, proves that the market has cooled to a level that's very supportive for buyers. Seeing that fixed interest rates have dropped by 1.37% and weekly incomes rose by 3.49% means that household buying power is quietly recovered while the wider crowd has been distracted by negative headlines.
It's a great big fat window of opportunity. David makes an excellent point that the reassessment of rateable values back in 2024 contributed significantly to bringing realistic pricing back to the market, especially in places like Northland and Marlborough. And the reason for that is because home buyers tend to look at what the government values are, even though it really isn't any sort of record as to what their market value is. But as a financial advisor, I want to highlight that warning at the end of the report. The Reserve Bank talking about future OCR increases means that we are in a rising interest rate environment. When the OCR climbs, so too do mortgage rates. So you should always stress test your affordability using higher interest rates than the long-term average. I like stress testing at 7% or 7.5% interest rates. If you can afford that, when combined with good strategies for mortgage management, this really helps to reduce the risk of becoming a motivated seller.
That is the absolute reality. Many buyers are suffering from analysis paralysis, waiting for more certainty, waiting for the election to be done, waiting for the war to finish. But if you wait too much longer, you could be competing with a wave of other buyers coming back into the market, which we are seeing right now, which will reduce your ability to negotiate on the purchase price, as higher demand tends to push up those house prices. Now is the time you can get a deal.
Exactly. This flat, stable phase of the property market, it's the ultimate sweet spot to negotiate. You've got lots of listings to choose from. Vendors are generally pretty realistic, and annual affordability has improved by double digits in nearly every region across the country. The key is to act counter-cyclically by buying before everyone else jumps on the bandwagon, securing a great deal while competition is low, and work with a mortgage advisor to help you to structure your loan so you're better placed to manage any volatility in the interest rate environment.
So that wraps up episode 21 of the New Zealand Property Insights. We looked at the severe financial squeeze facing retirees on fixed income, the high stakes political debates surrounding interest deductibility rules, and the outstanding double-digit improvements in home affordability.
If looking at these long-term demographic, legislative and affordability changes has made you realise that you need a personalised financial plan, or you want to understand how to build your own buying rules in a changing market, our team is ready to help.
We invite you to join us at our next completely free online educational masterclass called How to Succeed with Property Investing. It's highly practical, data-backed session designed to show you how to establish your buying boundaries, maximize your borrowing capacity safely, and evaluate changing regional demand.
There's absolutely no sales pressure and zero obligation to buy anything because our company doesn't sell property. We're 100% independent, focusing entirely on your education and strategy. You can find the registration link directly in our show notes, or simply go to propertyapprentice.co.nz to register for our next free event.
Thanks for tuning in.
Thanks for listening. See you next time. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.